Top three things in my notebook. Number one will be the 10-year bond yield. Number two will be oil. And number three will be Russia. First on the 10-year bond yield. So again, lower for longer. We're at 185 on the 10-year bond yield. No support on an immediate term trade basis to 182. That's a very immediate term. So you might say, well, that's not a lot of downside in bond yields from here. If you want to go intermediate term, you have no support to the all-time closing lows. So the all-time lows in bond yields we still think are very much in play, in as much as they are in Germany. We still like German bonds. We still like U.S. bonds. We still like any bond that is still traversing this path of people that don't understand that rates are going to be lower for longer. So again, the data yesterday was the real key in the U.S. You had both the ADP employment data and the ISM both missing and slowing sequentially. Missing Wall Street expectations, who cares? Slowing sequentially, in other words, slowing on a month-over-month basis, and then slowing on a year-over-year basis is what we're looking at here when we're looking at all the data. What we really care about is the rate of change. If you get the rate of change right, you tend to get bond yields right, because guess what? They map each other. So again, one goes the same way as the other. And again, the rate of change in the U.S. economic data has not been good, certainly on that front. And if indeed the Fed is, quote-unquote, data-dependent, you would say the data yesterday was just not good data. You'd say this morning maybe jobless claims is a little bit better. Not quite sure what you'd do on that other than buy more bonds if, in fact, they sell off. So again, you've been doing that for 15 months, and we congratulate you. Maybe 16 to 17 months, and your 401k salutes you. Second point would be on oil. You got the bounce, and then you get the fade. So again, just use the risk range, please. Again, the risk range is defined. We outline it every day in the daily trading ranges. You can see that on our website. Again, it's a very simple process. You sell at the top end of the range. You buy and cover at the low end of the range. So again, if you're a short seller of oil, you wait till we get to the low end of the range. The current low end of the range for WTI is 45.81, and immediate term trade resistance is 50.88. So again, you got up to 50.88, you sell oil, you get back to the 45 zone, and you cover some of those oil shorts. Again, it's a very straightforward deflation strategy. We've been playing this, again, going back to September, really July, September. And again, we wouldn't change that this morning. Again, we still think that being exposed to anything energy related, particularly things that are levered, is not a good place to be. Now finally, just to hit on Russia, that's a very levered play on oil. So again, we've been waiting for an immediate term trade overbought signal in the Russian stock market. We're going to get that this morning closer to 929 on the Russian Trading System Index. If you're not looking at that specifically, a lot of people are looking at the RSX, which is one way to play it in terms of buying puts or shorting the RSX. However you express your positions is up to you, but at the end of the day, I'm telling you that today is a good day to sell Russia. Again, we're at the top end of the range with no support on the RTSI, closer to 837. So a significant amount of downside. And again, Russia was up this morning. If you're looking at it right now, I think it's still up. So again, we want to short things when they're up within bearish trends, because that's how you make money. And those are your top three things.